Welcome to Kelly Paper Online Training. My name is David Mount. Thanks for joining me for this Sales Skills Training module. This presentation is titled Understanding Gross Profit, and here's our objectives. First, we'll define gross profit and profit margin. We'll talk about margin versus markup, discounting and gross profit, and finally, product mix and gross profit. So what is gross profit? Gross profit is the difference between sales and cost, excluding overhead, payroll, taxes, and interest. What is the difference between gross profit and gross profit margin? Gross profit margin expresses the relationship between gross profit and sales revenue. It is a measurement of how well each dollar of the company's revenue is utilized to cover the cost of goods sold. It is expressed as a ratio of gross profit to sales revenue, usually in the form of a percentage. Margin versus markup. Margin and markup are terms that are commonly used in retail businesses. They are also commonly misused and misunderstood. Margin is the difference between the selling price of a product and the cost of a product. Markup relates to the process of calculating the price of a product based on its cost. For a business that sells products, the wholesale cost of a product sold is known as the cost of goods sold or the cost of sales. Understanding these terms and how to calculate them are important keys to maximizing your gross profit while remaining competitive. Let's take a look at an illustration that demonstrates sales, cost, gross profit, profit margin, and markup. If we sell our product at $10 and our cost is $5, that means our gross profit is $5. As you can see, the gross margin is 50% of the selling price of the product. This means that we marked the cost of the item sold up 100% of the cost of goods. Let's break this down a bit further. To calculate the profit margin in this illustration, divide the gross profit of $5 by the selling price of the product, so that $5 divided by $10 equals 0.5 or 50%. You remember how to turn a decimal result into a percentage, right? Just move the decimal 2 spaces to the right and change it to a percent sign. Now let's calculate the markup for this illustration. To do this, we take the cost of the product and multiply it by the desired markup percentage, so that $5 times 100% equals $5. Then we add the $5 resulted markup to the starting cost for a result of $10. Here's an example with the same sell price but a different cost. Here we see the sell price of $10 and a cost of $6.50. This means our gross profit dollars are $3.50. This is a profit margin of 35%. To achieve this result, we marked the product up 54%. This illustration combines the 2 previous examples. If we have 2 products both selling at $10, we can see that the combined sale is $20, with a cost of $11.50. Our gross profit then becomes $8.50. This gives us a combined gross profit margin of 43%, and our combined markup is 74%. Since we don't mark all products at the same ratio, there may be times where you need to calculate the markup based on the finished sale. To do this, divide the gross profit by the cost. This gives you the markup percentage. Now let's look at an illustration of a Kelly truck filled with 800 cartons of Kelly copy. If the cost is $21,200 and the sell price is $28,960, this would give us a gross profit of $7,760, and the gross margin would be 26.8%. The markup would be 36.6%. Now notice how much of this order represents the cost and how much represents profit. Now let's consider what happens to the same order while applying a discount. The cost obviously is the same. The selling price drops for the customer, as does the gross profit dollars and the profit margin. Notice in the illustration of the truck that the profit shrinks. Now, discounting is sometimes necessary to keep customers and to go after bigger parts of our business, but it's important to understand the relationship between discounting and gross profit. Now let's take a look at an order with a better product mix. As you can see, we have a variety of products listed in this example. Taking a closer look at this mixed truck with a discount applied, our total cost is $12,379, with a sell price, a discounted sell price of $19,200. This gives us gross profit of $6,821, with a gross margin of 36%. So let's compare this to our Kelly copy only order, where the sell price was $27,512 with a gross profit of $6,312 and a gross margin of 22.94%. As you can see, the better the mix, the greater the profit. In review, gross profit is the difference between sales and cost excluding overhead, payroll, taxes, and interest. Gross profit margin expresses the relationship between gross profit and sales revenue. Markup is how we determine our sale price based on the product cost. While discounting is an important part of our sales process, we must remember how it impacts profits. Product mix also has an impact on your overall profit. Just like our mixed product example compared to the Kelly copy only example, always look for opportunity to sell products with a higher margin along with the more competitive, lower margin items. When facing highly competitive situations, contact your district manager for support. This concludes our presentation on understanding gross profit. If you still have questions, contact your district manager or call me, David Mount, at extension 225.